So today I would like to talk about Oatly. This company sells the oat milk products. They also sell the cream and the ice cream as well. So it's an interesting company. If we take a look at the stock price, we can see the stock price was very high in 2021 and it declined over the years over 95%. So this is a big decline. So from the stock price, it looks cheap, but we have to take a look at the financials to find out if this company is actually cheap or is still overvalued. The first thing we can recognize about this company is the small market cap of $558 million. So this is a small company. It could mean it has a lot of room to grow, but it also can mean it has more risk because smaller companies are more likely to go bankrupt. So we have to keep this in mind. So now we're going to take a look at the financial foundation. So we want to see the revenue growth over the last 5 years. And especially for the smaller companies, we would like to see a high revenue growth. And as we can see here, they have an incredible growth over 2020. It was over 100%, which is great. Then it was in 2021 over 50%, then over 12%, and then over 8% in 2023. So the growth is slowing down, but it's still a great growing company. So it's a check here. Now we would also like to see the free cash flow growing. So this company is still unprofitable and the free cash flow is negative, but we would still like to see it improve over the years. But as we can see here in 2019, it was minus 92 million and then it increased. So the number got even worse. And in 2021, it was even worse with $485 million minus. So now it's improving a little bit, but it's still significant in the negative. So it's not a check here. And this can be very risky because this company is losing a lot of money. Now we're going to take a look at the balance sheet. So we want to see the cash on hand, at least 10% of the market cap. So the cash on hand is how much money the company has in the bank. So we can see here, actually we're going to take a look at the quarterly. So it's more accurate number. So we can see here their number decreased over the years and it's now at 142 million. So I think they use this money to pay back the debt and obviously to also invest in the business. And we want this number to be in 10% of the market cap. So 10% would be 55 million. So the cash on hand is looking good. They have more money than what we would like them to have. So this would be a check here. Now we want to take a look at the debt as well. So the debt should be under 30% of the market cap. Why? Because we don't want to have too much debt. This can mean more likely to go bankrupt. So we will take a look here. We have the short-term debt. It's about 336. And then we also have the long-term debt. We're gonna add this as well. It's about 153. So this means round about 489. And we can see here it's a big number, so they have a lot of debt. So we want this to be under 30% of the market cap. So 30% of the market cap would be 167. And we can see they have way more debt than they should have. So this is definitely a risk. And I don't like to see that. And it could be really risky to invest in this company because they have a lot of debt and they are not profitable yet. So we have to keep this in mind. So I would like to give my conclusion about this company. So this company looks interesting because the stock price decreased so much. So people could think that this company can recover again. So it's not impossible. I would like to start with a good thing. So they have a growing market. So the vegan products are very interesting and people like to be more vegan nowadays. So this is a good thing. They have a popular brand as well, so I think many people like the brand, and I hear a lot of good things about this brand. Like, people say it tastes better than the other brands, so this is a good thing. But I also think they have a lot of competition. So especially the supermarket brands, they also have these products and they sell it way cheaper. They also have too much debt. So we already saw that they have a lot of debt. The cash gets lower. So the cash they have in the bank gets lower and lower every year. So at some point it will run out. And they have a very high negative free cash flow. So they're losing a lot of money every year because they're not profitable yet. So I not really recommend investing in this company. So what could happen to this company is that they get bought from some bigger company. So this could happen, and then maybe the stock price will increase because it's very low right now. But I don't really see that happening. But this is probably the only way in my eyes for this company to really make the good return in the stock price, or it gets some hype somehow. So I hope you liked the video, and please don't forget to subscribe and like the video.